Want to write questions in the chat, and I'll definitely make sure we have time to go through of them later. And let's rather make this an interactive session than like a presentation only.
Peter,
First of all, yeah.
Agreed. We should make it as interactive as your background. I love that you have this video background. If everyone hasn't noticed yet, it's the coolest thing ever. Peter,
Kind of moving.
Yes, it's the best. I thought I had the coolest background of all time, but I think you might have me beat. Speaking of interactivity and questions, Peter, would you mind if we started with me asking you a few questions?
Not at all.
Okay, cool. That is the right answer. Peter, what is one of your favorite investments you or the firm has made in the past year?
I would probably pick one of our most recent investments, and it is one we actually announced today. So why don't we chose that? It's a company out of London called Lindus Health, and it's clinical trials for health basically, and it's a new way of next gen CRO and doing end-to-end clinical trials for health tech. A very exciting team that is, both active in Europe and the US. It was an 80 million A round that was announced today. So as it's a company we're very excited about, and as it's the word of the day, as it was announced today, I'll name that. But they're in the portfolio is always like that. You're, especially about recent investments, you're excited about many because you just recently as a team, got to conviction and decided to invest. And a couple of months later, it's so hard to tell like who's sort of like gonna really deliver and be sort of like super well performing, and that it gets easier a few years down the line versus very recent investments.
Yeah, well, congratulations. We obviously planned this in conjunction with that. No, just kidding. But thank you so much for that answer, and so excited for you. Moving on to our second question. What has most surprised you about venture capital this year?
I think one thing that everyone was kind of expecting was that we or like everyone talked extremely negative about the market. And what surprised me, I think the most, is the hype in valuations we're currently having around AI. So I think AI is probably an area where most of VCs and also many operators and founders are extremely excited about. It's a big impact on the ecosystem and technology in the future. But as we just came out of 2021, where in SaaS, let's say 100x ARR was normal for companies to raise very, very expensive rounds. And now last year, or end of last year, was like sobering up and getting like to new levels and more new reality. And you hear people like, oh yeah, I mean, like 2021 was so inflated and like it was too much. And here we are, 2023, companies doing 500K ARR, raising on like 200 million, or doing zero revenue, doing raising on 300 million, like very hyped AI rounds. And I think I wouldn't have expected it to that extent. I mean, we're all super bullish on the area, but I wouldn't have expected it to translate in some areas in such a round and valuation hype.
Yeah. Well, that was a great answer. I don't think we've had that answer yet. So thank you for sharing. Our next question and last question before I hand it over to you, who everyone is actually here for, and I'll stop talking. Who is one of your favorite co-investors?
I would pick an angel here, or actually two angels, which are the Sender founders. I personally sit on two boards with them, and Sender is a logistics unicorn from Berlin, and the founders do some angel investing, and I work on two companies with them, Cargo One and Timber Hub, and David and Julius, also work with the board there, and very helpful, very good, operational input for the founders, and just very pleasant to work with. And that's something I enjoy a lot, and the exchange I really value.
Yeah. Well, thank you so much for all your answers and insights. I know we are going to get a lot more information out of you in the next hour. So with that, Peter, feel free to start your presentation.
Cool. So first of all, great to meet you all. I'm Peter. I'm based in London, a partner here at Creandum. As many of you know, we're pan-European early stage fund since now 20 years. And the topic of raising capital is something we talk a lot with our portfolio, and often founders come to that, to VCs to discuss strategies and, understand, like, can we raise, how much can we raise? And we of course have a slight advantage of, like, looking at our portfolio and what is going on there. But also of course, as we sit on the investment side, and how would we behave in these things. And many of our companies have raised, last rounds, very big rounds in the past years. If we think, like something like Trade Republic raising an 800 million round, and these kind of things, so like very large numbers. But when it comes to 2023, we have seen much less of these rounds happening, and so the market is really finding the new normal. And I hope I can help shed some light on what the new normal is, and what it takes to raise capital in the current market, and back that up with data we collected in Q1 and Q2, and made a bit of a recent update to some of the things we already talked about at SaaStr here in London. And let's go through it. So starting with trends in fundraising market in the last 12 months. And I think that's the high level point we touched upon earlier. As founders and VCs, we were both hyped in the peak cycle in 2021. I think the memo here on the left isn't even exaggerated. When we saw what was happening in the market, VCs literally like pushing money into the market, like, take my money, term sheet within 24 hours, massive amounts and valuations. And today, end of 2022, beginning of 2023 has felt a little bit like here on the right of founders sometimes feeling ignored by VCs, or like it's much harder to get the right attention and for rounds to happen these days. But what does this actually mean the numbers? And we can clearly see here, when we're looking into this is US fundraising data from Carta, that the amount raised doubled from 2020 to 2021, from like 33 billion to 63 billion. And then over 2022, it kind of like collapsed. And we saw sort of like the bottom actually in Q1 so far, with only 12 billion raised. And when I say with only 12 billion raised, I have to put it a bit in relation, because actually it's a very similar amount to 2020. So it's also fair to say, like, hey, we just went back to 2020 or 2019 levels, and the outlier was 2021. But I think the encouraging thing here is, while we had a close to 60% drop year over year from capital raised, Q2 had a slight uptick. As you can see here, it went from to $15 billion and then 25% uptick. So there's some recent positive momentum, and it seems like we found a new base, or a new bottom, and it's going to continue a bit more stable and not dropping further. So heavily fell, but stabilized recently now in Q2. And we've also seen this personally in the market, where I think in particular in June, before summer, there's quite some activity going on in the market. Let's look at valuations. On the x-axis you have time, on the y-axis is the median pre-money valuation. And while Series A fell from the 48 million mark and now landed roughly at the 40 million mark, Series B dropped steeply from roughly 160 million beginning of 21 to more like 100 million today in valuation. So a much steeper drop. You can also see that seed rounds have, on the bottom here, remained relatively stable at 30 million pre-money, and also the fluctuation there has been much less. And also here we see the pattern of, like, actually we just went back to 2020 levels or beginning of 2020 levels in those valuations, and 2021 has been really the outlier. And for founders, I think the good thing to see here is as well that Q1, Q2, or Q2 in particular, it seems like we found a little bit of a new normal with, Series A valuations are stable. They're not dropping anymore. Series B valuations have gone slightly up recently. So hopefully we have seen rock bottom in Q4 and Q1, and we see sort of like first positive indications in the market. What is also interesting is the types of rounds and how this has changed. If we look at Q2 in 2022 and compare that with this year, 1 year later, every fifth round today is a down round. And the share of down rounds was roughly close to 10% in 22, and it now has doubled in Q2 to, or Q1, Q2 to roughly 20%. And it has, luckily also here we see sort of like a stabilizing trend that it's not, getting worse, actually improved roughly by 1%, but that we only see roughly 20% down rounds currently in the market. So down rounds are happening. It's something, when companies have raised on inflated valuations, we see them more and more, but at least it has stabilized in the market. Also, the number of bridge rounds is increasing significantly. So according to the Carta data here in the US, it's around 40% of Q2 rounds that were in like seed series A, B that were bridge rounds. This also increased by roughly 30% or so in comparison to the previous years. And here the average is from the last 3 years. So it also reflects what we hear from the markets, like down rounds are happening, extension bridge rounds are happening, and the data now reflects that. The data I showed you above was a bit more reflecting on the past 6 months, trying to keep it as actual as possible. But what we did at Creandum is we in Q2 in May surveyed tier 1 VCs from the US and from Europe, in trying to get to understand their appetite better. Like, what are you really looking for at the moment? Like, what are you willing to pay? What are you looking for in efficiency and growth, etc.? And I'm going to lead you through the data here. And the data was, 27% US VCs, 27% Europe, 47% from the UK, as many of the European funds sit in London. And when one thing we also asked and did there is like, what rounds happened in the past months? And this year is up until May, so up until 2 months ago, where we mapped the pre-money valuation and the ARR number on the x-axis. And the interesting thing here, or a few interesting things here. First, almost all the valuation outliers in the past months have been AI companies. There's currently a slightly different pricing happening for hyped, especially generative AI companies and rounds. Second, the A rounds that happened moved to more mature ARR, while in the past the standard A round has always been 1 million ARR. That's sort of like the rule of thumb. Current A rounds are more happening at the 2 million plus ARR, at least the more sizable A rounds that we've seen in the market. And it's a bit of reflecting a trend that VCs have looked for more proof points, or companies have waited longer to go out and fundraise. So there has been a bit of a gap in the classic 1 to 2 million or slightly above 1 million ARR range. And then given sort of like the ARR has increased for the companies to like 2 million plus, and you see here like 2, 3, 4 million. There's quite a few bubbles in between this range. The valuations have happened at either around 50 million or around 80 million. So if you were more at the 2-3 million mark, it has been more towards 50, and if you have had more like 3-4, it has more been towards 80 or 100 post. And thirdly, I think the seed rounds are happening also more clustered in towards a lot of pre-seeds we're seeing, and more mature seeds, like 700-800K ARR or even close to 1 million. So I mentioned a few of those things here already. A rounds are trending to more maturity. A extensions happening around 3 to 4 million ARR. So we've seen quite a few of extension rounds here. B rounds started at 5 million ARR, also with a tendency towards more ARR. AI deals partly playing a different league. And what is important to mention here is that the bar is actually high. So overall funding rounds have decreased, and there's less pressure currently in the market for VCs to do deals to shoot simply because of market sentiment. And the A rounds or B rounds that we saw happening in the market have actually all been pretty high growth. So while in some boardrooms it has been praised, or in some blogs or Twitter, it's like 2x is the new 3x. That's partly true, and more companies actually grow now 2x than 3x compared to 2021. But the rounds that have happened in the current environment, in the current market, and the good rounds that have happened by good investors here have been mostly like high growing companies, and this means 3, 4, 5x year-over-year growth. Then we see preemption rounds happening more and more. I think this has been a more recent trend also, that companies currently don't want to be out raising. But it's kind of like, we don't want to show that we need money right now, but are open for taking in money opportunistically. I think this has been a strategy which has changed a little bit compared to also 2021, where many tried to optimize for a structured process, get as many term sheets as possible, inflate things. And here it has been also a path to success, even more and more that preemption rounds happened when people that were really eager, or you just opportunistically talked to a few players and took money if you could. I think that's what I mentioned before. Like I think June has actually been a quite active month where we see more and more stuff happening. So the most recent momentum has been, at least from a feeling wise, better in the market again. And then this is the hot rounds of fast growing companies remain very competitive despite the market environment. I mean, the overall market is down. The most hyped AI deals, or like the fastest growing companies, they still get, if you're growing 6x and great market, great team, a lot of the things check out, hot round, multiple term sheets, you still get high valuations, and it still remains to be very competitive, but only for very, very narrow selection of companies. So where have multiples been for those rounds? At Series A, we've seen a median of 21 and an average of 25x ARR multiple. In concrete numbers, if you have 2 million ARR, this would be between 42 and 50 million valuation. At B, where there's less data points and a higher fluctuation, the range here was 15 to 35, while the average happened to be at 24x. And then on the right-hand side, you're seeing, the AI bubble, where it has been, a pretty broad range for some hyped AI rounds happening. But it's also fair to say, I mean, AI rounds are happening at the 25x multiple or 24x multiple that we see here. It's just a few of those hype rounds that made it to the right here. So most term sheets we've recently seen with companies with 2 million ARR, where I think looking at multiples makes sense, have been in the 20 to 30x million ARR multiple range. And yeah, let's move over to briefly to the expectation side. So we asked VCs here the question, like, what do you expect? And what's the ARR they expect at seed? As you see here, the majority is fine with less than 250K ARR, but there's quite a bunch that actually wants to see 250 to 500K ARR already at seed. So this has slightly moved up over the past years. Same for Series A. While in 2021 we saw many Series A's happening also in the 500K to 1 million ARR range, the current expectation what VCs look for, 67% is between 1 and 2.5 million, and 13% actually want to see even more than 2.5 million. When you talk to people in the market that are in the majority of like the 67% bucket, where it's 1 to 2.5 million, there's a slight tendency to be rather on the higher end of the 1 to 2.5 million. But generally, that's the range where we see most Series A rounds happening. But there's a slight tendency to rather have 1.5 million plus, maybe 2 million. At Series B, the majority looks for 5 million plus, 57%. But also, I mean, depending on company, 36% are fine with also less than 5 million in ARR. What do VCs consider as a healthy ARR multiple at Series A and Series B? For Series A, the most common answers we got was around 25 to 30x as a healthy multiple. If you assume a 1.5 million ARR, this would be a 37.5 to a 45 million valuation. And then you see the range going from 30% as 20 to 25x, 20% is 30 to 35x. So the range goes from 20 to 35x, or from in absolute valuation from 30 million to 52 million if a company has 1.5 million ARR. And then for Series B valuations, the total range here goes from like 90 up to 180 million if you assume 6 million ARR, while the majority, 55%, think that 15 to 20x is a healthy multiple with a 19 to 120 million valuation. But so as a summary, it's like 20 to 30x for A rounds and more the 15 to 20x for B round range. Of course, this is influenced by how fast you grow. The faster you grow, the higher your multiple can be. If you're growing 3x, your multiple will be lower than if you're growing 6x, usually year over year. And here we come to the question of growth versus burn. Like, should you still grow at all expenses, and what do investors expect currently? And as I mentioned before, growth expectations have gone slightly down. So I think 2021 is a clear answer, always like 3x minimum. Now 47% of the investors are also fine with like 2.5x to 3x range at Series A, but still over 50% look for more than 3x growth, 40% for 3 to 4x, and 13% for more than 4x. And for Series B, when companies are of course larger, that number shifts slightly, where half the investors are fine with a 2x plus growth, and roughly the other half looks for 2.5x more, and of which like 13% looks for minimum 3x also at B stage. But I said it's now even more balanced between growth and efficiency. So burn multiple has become a key thing, and kind of like one of the other key important metrics that is tracked. And what becomes very clear is like very bad burn multiples have a hard time. Well, this has been fine 2 years ago. It's something investors shy away from today. And for Series A, the burn multiple range goes from 1 to 3, roughly, that investors are fine with. I think the majority here, 40% is fine with 1.5 to 3x, or expects or looks for that as a burn multiple. And at Series B, this becomes even more strict, and people look for a burn multiple less than 2x. So 40% look for 1 to 1.5. 53% are fine with 1.5 to 2x. But basically, no one indicated that he would be interested in a larger than 3x burn multiple at Series B stage. Everything comes at the trade-off. And here comes a question we discuss in a lot of boards: what to prioritize, growth versus efficiency or profitability. And unfortunately, it's the answer for this one is both. Growth and burn needs to be looked at in combination. The times when high burn was fine, if growth is high, have shifted, and investors want to see both at the same time, and hit the bar for an investment. So it is actually, unfortunately, both. I think the last variable which comes into play is actually how much cash you have in the bank. That also defines a little bit of how much you can play around with it. Here's a fantastic metrics that one of our portfolio companies actually introduced to me, and it's the burn multiple year-over-year growth metrics. And then you can take some of the benchmarks that are available online and put them in here in lines and see and compare yourself to the percentiles. But I think that one here, that matrix, is a great way how to visualize it in your internal discussions or also in your board discussions, and prioritize on like, hey, are we fine with just being in the 50th percentile of growth if efficiency is X, Y, Z, or the other way around? So what are the implications for fundraising for you in the current market? Markets got tougher. So my first recommendation here is widen your funnel. Like if you go fundraise, expect to speak to more players, and have more warm leads, basically more warm VC leads. Plan in and take more time for the fundraise, as the rounds are not happening as quickly as in 2021 anymore. Adjust your valuation expectations. I mean, if you supersede them, it's great, but the market has changed, and I just gave you a few indications of where multiples are, and adjust your valuation expectations close to that. Then it's flat and down rounds are happening. We just saw the data for it, and definitely prioritize making a round happen over pushing on valuation. In the long run, this usually pays off. Getting the right amount of money in, being able to execute, being able to build, whereas optimizing for dilution only is or other things that stop the round from making happen is a tough one in the current market. And then be a bit more open towards opportunistic rounds, which we discussed before. So the key takeaways right now is the market currently prefers slightly more maturity, so rather late seeds or A rounds with more ARR. Average ARR multiples for A's are around 25x, for B around 24x. At the same time, investors consider 20 to 30x and 15 to 20x as healthy. It's an interesting aspect where, for example, for Series B, investors consider 15 to 20x is healthy, but actually they're willing to pay some, on average currently up to 24. So it's sometimes still a discrepancy, depending on also how competitive rounds are. And then growth expectations have slightly gone down, while efficiency expectations have gone up. And so my recommendation is, accumulate enough ARR before raising, prepare your fundraising well, plan more time, speak to more funds, adjust valuation expectations, consider rounds when opportunities arises, and be tactic sort of like on the timing of when you go out. Avoid Christmas time or like summer seasonality, when in August people might be slightly more off on vacation or these things, and time it well with sort of like growth momentum that you have in your company. And hopefully, if you need to raise this year, you can be successful with this, and some of the insights here will help you for it. But that was the last slide, and where I want to open it for any questions you have.
Awesome.
To go through it.
Yeah, feel free to take down your slides so we can see everyone's faces while we are getting these questions answered. But thank you so much, Peter. We always say, come with stats, come with data. And boy, did you. That was great to go through. And I'm sure we're going to have a lot of questions on it. So to start off, what are some ways that early stage companies can stand out in this market outside of these numbers? Are there any other things you can think of that these companies should be thinking of right now?
Yeah. So one thing because I also just saw one or two comments here. When I talk about so like where can you stand out and these things, I always come from the perspective from one of the larger one of Europe's largest early stage funds in that sense, and it's comparable to the large US early stage funds, etc., where all those VC funds that have this kind of profile look for billion-dollar outcomes, and look for the outliers. And so many of the things I just talked about are geared towards outlier potential and these things, and what sort of like top tier VCs and these kind of VCs look for. Because I saw the questions like of like multiples being different, and we see much lower in the market, and it's really like that's like the top 20% of the market, or like the top 10% of companies. What are the good, very strong rounds happening in the market? And this is sort of like the data from it. And the VC survey was sort of like from tier one data. And so that's why multiples are higher there, valuations are slightly higher there than what you will see as sort of like the general average in the market. And this also applies to this question here. I mean, like, what are we looking for? What are top funds looking for? Besides what I just mentioned, it is one key aspect is unlimited upside. It's like if you really can show a big vision, if you can show how to build a multi-billion-dollar company, and then it's a great, how can you stand out beyond that? It's a great, well-rehearsed pitch. It's a strong vision. It's a strong team and complementary, showing sort of like how complementary you are, maybe also on the founding team with different skill sets. And one additional aspect in efficient growth is of higher organic share and variety is of course something people always love.
Thank you. I know we did have a lot of questions about those numbers, multiples, etc. If anyone does want to unmute and add to the conversation or has a additional question to that, feel free to do so now.
Maybe I could still ask the question, Caitlin. So, Peter, what would be the typical average ARR multiple for the non-outliers? Someone had mentioned too is like 5 to 7x ARR would be like really great.
Yeah, I mean, if you look at, I think that's in line with it. So if you are growing like much slower, I mean, as it was in the question also there. The rounds, the data from the rounds that tier one funds has been the 3 to 5x growers mostly. And so if you're growing only 100%, your multiple will be considerably lower. And I think the range you are saying of like the 5 to 10x or so is the more realistic one for that. And I think you can always take the public comparables. And there it's currently, trading more towards like 6x, 7x, or like between 5 to 7x, depending on company growth. Some make it to 10x growth, and you can take that as a comparable. But it also depends on stage. If you only have 1 million ARR, multiple often isn't the right, comparable. If you are at 10 million ARR, then you will be, evaluated on a multiple basis. But if you're still small, it's based more on other factors than on multiples.
Great. Thank you, Peter.
Of course. We have a question. I'm not sure if your name is Foley 8733, but Foley possibly, if you do want to ask out loud.
Yeah, sorry. That's like the personality types. So one of them's a Colby, one's a Myers-Briggs, and the other is an Enneagram. So that's what all the weird numbers are for. Anyways, I was asking about like the dilution per round. It seemed that like the check sizes in relation to the post money was around 20%. So it's like if you raise 2 rounds, A and a B, or I guess even if you do seed, right, then it's over 40%. And that seems kind of a lot. I didn't know if you got any insights into that from your survey.
Yeah, not particularly in the survey we do, but I think the ballpark you can say is rounds have roughly 20% dilution, and that applies to a normal sizable seed round, that applies to a round. At B round, it slightly goes down. So I think the range for B rounds more like 15 to 20%. And then for C rounds, it goes down even further. If we also see B rounds with 10 to 20% dilution, but I think for seed and A, it's still fairly standard to be more closer towards the 20% dilution. So yes, after a Series B company, it's you usually have seen around 50% dilution as you mentioned, or 50-60% partly.
Any follow-up on that?
It just seems like a lot when you really even when you're A or seed in A and you give away 40% and you're just barely finding product market fit, right? That just seems excessive almost. So would you recommend almost kind of cratering the profitability line in those early stages just so you don't have to dilute until you prove whether your company is actually can gain the 3 to 5x that you're looking for? It just, to me, it's just a lot.
I mean,
I don't know.
The thing is here, can you? That's the thing. I mean, like, if you manage to dilute only 15% in your seed round, fantastic. That's great. I think the minimum I've seen for seed rounds is always 10%. But like, also from fund economics, if you raise from the large billion-dollar funds from the Valley, etc., like they require double-digit % ownership as well, and that automatically you end up with more than 10% dilution. But if you also think about it, what is a company worth? What do you need to build it out? So let's say you're raising a 2 million seed round, and you don't have a lot. So you need 2 million for the next 18 months. And if you're diluting 20%, your company will be valued at 10 million euro at seed stage, where you don't have a lot. Like let's say you're very early. If you would say, I only want to dilute, in your rationale, like 10% or 5%, your valuation would need to be 20 or 40 million, basically on almost nothing. And that investors are not really willing to pay for. So it's like, what is your company actually worth? And at seed, it's actually not worth a lot, and it's fictional in that sense. And that's why it's a mix of what is a company worth and how much money do you need. If you can afford to build without money, that's great. But you have to think about, if you are starting out, and if another company is starting out, if you're bootstrapping and your competitor is raising 3 million and can maybe execute at double the speed, will you be the winner, or will they be the winner? There are great companies both ways. We see more of the billion-dollar companies that have gone the fundraising route than the bootstrap runs. But for example, Celonis, which is a $10 billion SaaS company out of Europe, they raised their first significant round at 10 million ARR and hardly raised anything before. If you can do that, that's of course the dream.
Thank you, Peter. Our next question comes from Anand.
Hey, Peter, thanks a lot for all the statistics. I do want to actually ask you a couple of different things on whether you're still looking at rule of 40, the number of customers, CAC paybacks, especially when it comes to Series B, and how are you actually like really evaluating, whether it's really scaling up or not across these? Yeah.
So all the standard SaaS metrics like payback time, CAC, LTV CAC, churn, retention, net dollar retention, these things, like every investor looks at them, at least from Series A onwards. I mean, seed is different, but like Series A onwards, they're there. And for stuff like Rule of 40, I think that's a metric which more comes into play, like Series B, Series C rounds. Like the later stage you are, the more important is that metric actually, and then investors are looking very closely at it. So the answer to this is like, yes, we look at all of this. I mean, Crandom in particular, we focus on seed and Series A, but for late stage rounds in our portfolio, this is clearly happening.
Okay, thank you. You guys are really throwing me for a loop today with these Zoom names. Our next question comes from Tor 200 Blor. I don't know, but
oh, hey,
welcome.
sorry about that. It's just because it's like the office name. Hey,
Yeah.
Peter. So thanks for all your analysis. Is really helpful. I was just wondering, of the deals that were being shown, like within the data, what was the split between AI versus non-AI deals? Because like some of the growth metrics you were showing were pretty high. So naturally, I assume they were maybe being pulled up by a lot of AI deals.
I don't have the data split in my mind of like AI, non-AI, but anecdotally, from the rounds that we've seen in the market here and happening here, also of the non-AI rounds. And for example, we did in the past 12 months several SaaS companies that were non-AI, and they were all growing in that range. Some were even growing beyond that range at Series A or Series A extension stage. And so this is really focused on what are sort of like divisible hotter rounds that it takes to bring top tier investors sort of like on board. While we've also seen, rounds happening at like with 2.5x growth, but then multiples look completely different. And then it's also a different type of investor set that does and looks at these rounds. But if you look at the rounds that, I don't know, Sequoia and Excel, Crandom, Bessemer, or Index, whoever it is, have done these, you can expect that these have been most of the times more than 3x growth at Series A stage and at Series 8 stage. At Series B, C, like the larger a company is, the less you need to grow. We saw the data before.
Got it. So essentially, it's a lot of the data is like you're also taking a look at some lead investors or investors around the table and kind of getting you directionally know these are the typical top quartile or top tier funds, and you're seeing just like a lot of general patterns of those are deals that happen to be growing faster and happen to be doing things at higher multiples.
Yeah, and of course the AI deals that you mentioned. AI has currently tailwinds, and there's a lot of AI companies with high growth, and those also because of the vision, but also partly because of the fast growth they have. There have been more of those hyped AI rounds also happening.
If you want to learn more about AI, reminder, we have an AI day at SaaStr Annual. All right. For additional questions, you mentioned the pitch deck and that's another important factor. What would you say, 1 to 3 things that differentiate a good pitch deck to a great pitch deck?
I think first is really having a storyline throughout the pitch deck. Investors are also people that like to hear stories, and they don't just want to see, I don't know, one screenshot of the product and then just a few metrics, but they want to hear the story behind it. They want to see the vision. And so a pitch deck that we can really outline the storyline is usually a very good one. So not make it just facts, but make it a mix between the founder story, the company story, and the vision behind it, combined sort of like with the standard facts that you have. What is another thing? Not too short, not too long. I would say for, let's take seed round, 15, like 10 to 20 pages max, or usually more like 10 to 15 pages. A round, 20 to max 30 pages. But like 20 to 25 is typically good for an A round. Series B, it can be longer. And then for the growth rounds, you have a lot of appendix and these things. But, you know, don't overexhaust it in length. And the third one is maybe not about the pitch deck, but about the pitch itself. It's usually good if you use your slides for pitching. I think when we analyze it, it's better to pitch with your slides than when you have sent the deck. Assume, yeah, the investor has read the deck and I just pitch voiceover and like he will remember it. Use the slides and pitch along the slides. It just helps.
Yeah, that's some great insight. Thank you. And a good reminder. Yeah, everyone wants a story. Everyone wants to not just read some slides, but to have some background and some skin in the story as well. Along the lines of those pitch decks, cold emails, what are maybe some of the best cold emails you've gotten or ways for your cold emails to stand out?
Yeah. The most important rule for cold emails is make them short. Because if someone gets a very long cold email, there's the trade-off, like should that investor gets, let's say, 100 cold emails, like, should he read all the long emails? I mean, like, will he go through it in detail? If you keep it crisp and to the most relevant things, that's the best thing. And then just be very direct. Start with the right name. You can't believe how many mails I get with the wrong name, even the wrong font or so that's partly addressed. But of course, the name, hi Peter, and then relate to something. I've noticed you've been interested in that, or hey, I saw Crandom is invested in Spotify, and thus we are eager. We are a music startup and want to chat with you. And then the next point is then you are 2-3 highlights about your companies, like about your team, about what you're building, and about where you stand. Of like, we already have, I don't know, 50 customers within 1 year, or like your ARR number, your amazing growth. Keep it short and just say, look, here's a link to our deck. We would love to chat, let us know.
Yeah. Okay. Thank you. Yeah, agreed. That like too long, didn't read, definitely comes into some of these long emails or long pitch decks. When companies are, or these early stage companies are pitching to you, what number do you want a clear path to in ARR? What do you want to be shown from these early stage companies?
Sorry, can you repeat that?
So in these early stage companies, what do you want a clear path to 100 million ARR? What is,
okay.
Is there a number there that you are looking for?
Yeah. So the math is following. You typically, VC funds look for our size, look for $1 billion plus outcomes. Ideally, of course, the potential to do multi-billion dollar plus. And what's let's say SaaS public multiples are 7, 8. Let's say it's a higher growing company, and for simplicity, let's do 10 as a more favorable case. 10x multiple. So for a $1 billion company, you would need to get to 100 million ARR. And then you can play around. You need slightly more if you make the multiples more conservative, then it needs to be 120 or 130, and slightly less. I don't know if your growth is even higher and you need less. So 100 million ARR is typically the thing. But I would say typically funds look for companies that cross the 100 million ARR, but have the potential to go for 200, 300, 400 million ARR, so they can go to the multi-billion dollar range. Because in the end, you look for fund returners. Example, fund has $500 million fund, a fund returner with a 10x multiple. I mean, let's say you own 10% or 10% of a company, it would need to be a $5 billion outcome where the fund owns 10% to be a fund returner. And that's sort of like what the ideal case is, like the best upside that funds look for, and like, of course, as high as possible, but that's the math behind it.
Yeah, no, thank you for diving into that. We have a great question in the chat from Hubert. If you do want to unmute yourself. Okay, I can ask on your behalf. If not, a pre-seed B2B SaaS investor once asked me, what is your biggest worry? What is the most insightful answer a founder can give to get investment? Should the answer be big competitors or product market fit or scalability or unit economics, etc.?
This actually really depends on your business. And I think that's more an honest answer typically that people look for. It's like, hey, we potentially partner up with this company. What are the challenges where we as an investor gonna, will try to help you? What is the challenge if it's an seed round? What's the challenge we need to work on between seed and Series A and getting you to the next sort of like stage? And so I would say, given thoughtful but honest answer on what is actually the challenge in your market. For some models, if you have a model with a high service component, gross margin might be a challenge. If you're going into a competitive market, it might be competition. So it's really about the current situation and what is there's no right or wrong here, as long as you don't say, like, oh, competition is way better than us and we have no way how to solve it. But like, hey, there's competition, but here's how we differentiate. And this is our approach. And this is why we win. But it's still a large challenge.
Yeah, you said there's no wrong answer, but is there something that would worry you if they said it was their worry?
If entrepreneurs haven't thought about it, it's like, let's take competition as an example. Like, oh yeah, my biggest worry is competition. I say, okay, yeah, tell us more. And then it's like, oh yeah, I mean, they just have an amazing product and like, winning customers against us. Or like, if you don't have an answer or like a thought of like, hey, we are currently working on product differentiation here or go-to-market differentiation here on like how to tackle that. And this is, like what is a big challenge for me and a worry for me of like how I do it right, but these are the potential solutions and how I'm thinking around it. This is more what I look for. I think what is a no-go is just stating a problem with this is unsolvable.
Yeah, no, I think that is great advice across the board, regardless of industry or situation. I think we have time for one more question. Peter, I know
one no-go I have for that.
Yes.
People overvalue team quite a lot. And if you're an early stage company and you will say like, oh yeah, my team sucks or something like this is, I just wouldn't say.
Okay, yeah.
You can't get yourself out of that.
Definitely a bad thing to say. Last question. I know we've been drilling you for the past 20 minutes or so we appreciate you answering all of these, but our last question will come from Andres.
Peter, thanks for your time today. It was really great. What are your thoughts on how pre-revenue SaaS companies can best position themselves for that pre-seed round in the current market environment? There seems to be a bit of a chicken and egg situation with regards to growth on the revenue side prior to getting that investment.
Yeah. As said, I mean, pre-seed activity in the market actually has been pretty solid because sort of like it's still the cheap rounds or the early rounds, lower valuation bands, like, all the multiple compression that we see in the later stages is not really happening at pre-seed stage at the moment. So activity is actually quite solid. So the market is not too bad for pre-seed, I would say. How to position yourself best without revenue? It's show sort of like customer interviews, so show potential customer interviews. Try to show other proof you have, be that a great product build. Hey, we've spoken to 50 customers, show quotes from that, show notes from that, have a fantastic product demo, maybe have a loom of your product demo that you can send out easily so people actually see how good that is. And try to find other indicators, be that on market, on your product, on customer validations or references that can give you or proof points already before revenue.
Great. Okay. I think that is all we have time for today. Peter, we so appreciate you taking the time, leading us through your deck, answering a ton of questions. It has been such a pleasure, and I know we all learned a lot from this session. If you like this session, talking about the data train, we will be back next week with Data Doesn't Have to Be Hard, 3 data myths and how to bust them. This is with former head of data platform product at MailChimp. Looking forward to seeing you all next week. All right.